welcome you all to yet another episode on our channel Talk of Town. We are here discussing with various subject matter experts in our episodes covering personal finance under the broad topic Beyond Boundaries. Today, I'm fortunate I have with me Mrs. Akhila Muralidhar, who is a founder of MoneyFit Financial Services, focusing more on the concept of FIRE. FIRE refers to financial independence, retire early. I also have Ashwin Kumar, the director of DAA Capital, and of course Mr. Prabhanjan, who is a SEBI-registered investment advisor running a firm called Elysian Advisery. Happy to have all the subject matter experts today on this episode. The most important discussions going across the globe today is the tariff war. I think that is the best thing that we need to discuss on before we get on to how this tariff war is going to impact personal financial goals for a lot of investors, and how do we navigate this particular phase. So, like always, I would start off with Mr. Rao. Sir, your take on the current tariff war.
Right. First of all, thank you, Ellen, for calling me on this elite platform. And one point I would also like to mention that looks like you will call all of us on a day where the market has already arisen. I mean, last time also there was market was rise. Today market was rise. So you all see a lot of bit of smiles on our all faces. So jokes apart. When we talk about this tariffs on on 5th of March, 5th of April rather, these tariffs were unveiled by Donald Trump, and it has given a sort of direction for this, the Trump tantrums.
Yeah.
So let me give a bit of a brief before we get into the main line. How these tariffs, he has put these reciprocal tariffs. The country has, calculated the deficit, that is the imports minus the exports for US, and they have divided that by the imports and arrived at a percentage. And approximately 50% of that they have put as a tariffs. So if you ask, is there any methodology? There is no method. They just arrived at one particular, direction where they have put the tariffs.
Right.
And of course, Canada and Mexico are exempt from these tariffs. And then whole lot of Asian countries or European countries, every country has been hit by these tariffs. And here, one thing I would like to bring to the notice on these tariffs is why it makes more important and why it has made the entire markets more jittery is tariffs are not just the tariffs. They are the tariffs including the trade barriers and the currency practices.
True.
These tariffs, what they have imposed by the US, are like, to me, it's a bargaining chips. And in some time, in a quarter or so, these are going to settle down. And especially for India, this becomes very important because though India has not been hit by the major percentage of tariff, it is in the 5th or 6th row, but still in a short term, there will be a lot of turbulence. But there are certain three key points which are very areas of concern as far as India is concerned. Number one is the quality control orders in the foreign trade barrier, which is very important. They have mentioned it. The second is India does figure out among the list of countries which are considered as currency manipulator. China being the number one, India also falls a bit of in that list of countries which US has unveiled. And number three is there is a concern by US that government procurement markets should receive some concessions, where
Right.
India does not fall in any of these three things. So leaving the currency, the tariff at 26 or 27%, leaving that aside, these are the three concerns which India is battling, which would get to my mind, it will get into a long-lasting, war. So, and of course, I think what we hear from the government of India is they are already started these back channel talks with the US government to take care of these quality control things. The second is the government procured markets. The third thing which India really needs to work, India and also the Reserve Bank of India, which really needs to work is on the currency. So we need to arrest the fall of the currency, because if we see, though we might have made money in terms of Indian rupees, but in US dollar terms, I mean, the FIS have not literally made money. So this is the only area of concern where this currency tariffs, as far as India is concerned, is going to hit us big time. But of course, if we keep the interest rates low, and if we also and also another thing that is happening good because of these currency tariffs is the crude prices has come down. Today it's around, I think Brent crude is 64 barrels, so which is very good for a country like India. Second is the the foreign currency thing is 103 as of today, 103.2 or something, which is very good for the Indian markets. So these are the two things which will really help the despite the currency trade wars.
Got it. Got it. Interesting. So when we looked at the world markets, I think pretty much all of them were red last couple of days. Uh, I mean, India was no exception. Indian markets were no exception. Ashwin, a lot of stocks, I would say 90% of the stocks were down yesterday. And I believe a lot of investors would be thinking otherwise during these market conditions. So, how does the technicals look like? Where do you think we are headed? Uh, what do we need to keep in mind from a short term, medium term, and a long term point of view?
Hi, Len, and the other partners joining here. Sorry, there might be some minute disturbance in my background. There's an event going on outside, so you'll have to excuse me on that. And it's good to have Akhila madam on the show as well. So when you said fire, the first thing that popped up in my head is my daughter's name, because we have named our daughter Agni, so which means nothing but fire. So anyway, on a lighter note, that was on a lighter note. But coming to the more serious market conditions, look, Ellen, from the last time we spoke, a lot of analysts, including me, was gearing up to call a market bottom, and that possibly the final leg of the bull run had started, and we all got taken by surprise. I think that's one of the ways that the market tries to establish its supremacy, when everybody is like trying to say, look, we've kind of bottomed out now, it's for us to start looking at an upward journey. Market threw in a surprise, and my God, it was a massive surprise yesterday. The kind of gap down that we saw, not just the broader markets, but many of these stocks, was in a way a reminder of what had happened about 4 or 5 years back during the COVID pandemic. I don't think we had such a massive gap down in the last couple of years that we saw yesterday. But the important factor is we recovered, and a lot of stocks even came back to positive. And as we speak, today was a pretty decent day for the markets. Now, talking purely from a technical point of view, Ellen, the entire while Prabhanjan just gave you a whole bit of idea of what this tariff war is about, I would like to call it as another noise in the market. As a person who's looking at short term, yes, there is going to be a lot of volatility. The India VIX, what we call as the volatility index, shot up by about 45 to 50% in a single day, which is a massive boost. I'm sure a lot of option traders will be quite happy about it. But the people who got really hit yesterday or with the recent volatility are the people who are trading on leverage positions. People in cash market definitely look at this as an opportunity to average more, provided they are happy with the fundamentals of the company. And in the medium term and long term, the investors or the traders' memory is quite short-lived. You have 3 days of continuous rally. We'll all be forgetting what kind of an impact we had yesterday. So I just call it as a market noise. Stay focused, stay disciplined, not too much overthink about it, but also not to be in a hurry to make any investment decisions right now, because the volatility has to settle down. We don't know if we have made a bottom or there's one more round of sell-off coming in, because there is every alternate day there's a news flow coming into the market which could we could have just ended positive today, but something comes up tomorrow. Overnight in the US markets, followed by Nikkei, in Japan, and we might be opening gap down tomorrow. So when it's like playing with fire, just stay cautious, just stay a little disciplined, rather very well disciplined and a little cautious on the market, and not be in a hurry to make investment is the mantra. And once the market picks up steam, in fact, one data I was keenly observing today was some of the markets were brutally beaten. I think some of the Asian markets even hit a circuit breaker yesterday, and the sovereign funds had to intervene to bring them out of the doldrums. So India, in that way, there is no market that has been left out from the bleeding. But Indian markets are one of the best performers in the recent times, and I would still have my hopes very high on the markets. I know whatever said and done, the portfolio impact is causing a lot of disturbance and anxiety, but the ground reality is there is nothing much we can do about it when the entire country and the world is going through it. But try to find an opportunity here to encash on it and see some good compounded annual growth returns once the market resumes its upward trajectory.
Great. I mean, it's interesting. Coming to Mrs. Akhila, so you've been diligently working with a lot of clients on their, specifically on their retirement planning point of view. It's a very crucial goal for every family. So from a impact to the goal point of view, how do you look at these market corrections, and what do you advise during these volatile times to your clients? We'd be more than happy to know this.
Okay. Yeah. See, this is a time when I get maximum calls from the clients because most of them panic. Yesterday, almost, I had some 30 plus missed calls. Okay. But the thing is that it depends on where you are. If at all you are going to look at the impact on a financial goal, what stage you are. If you are nearing retirement, fine. But what are you going to use the equities for? Where are you using? Are you using it for any use after, let's say, around 10 or 20 years? Fine, that is okay, continue holding. That was what I would advise. But if you are actually looking to redeem it and move it into a safer investments, I say do it now, because it's their retirement goal, and obviously we can't compromise on that. Yes. And one more thing which I have been asked from, in fact, last 1 week is, can I, withdraw from my PF or withdraw from my FD? Can I withdraw from my emergency fund and put it in the market? No, you should actually buy low and sell high. It is low already. I said no. If you have an FD, you have a PF or any debt instrument, don't redeem it. Not under any circumstances. Whatever you are contributing to equity, keep contributing. Whatever you already have, hold it. But no change in your debt allocation at all. So that is something which I have advised. And also the other financial goals, how they have been impacted. Okay. So not much, I would say, because we regularly monitor the financial plans, and if their goal is just 6 months or 1 week away, we wouldn't have any, not 1 week, 1 year away. Obviously, we would have almost brought down the equity exposure to nil already. Okay, so the impact is almost nil, I would say.
Great, ma'am. Thank you. Taking cues from what Mrs. Akhila just mentioned, right? So people are ready to move their money from debt to equity, and there's a tectonic shift in the thinking over the last 1 decade, I would say. If it was, say, 10 years back, I don't think this thought process was prevalent. People, used to kind of move away from equity during such market corrections. Mr. Rao, coming back to you, looking at this change in thinking. So, what is your stance? Do you stick on to your asset allocation? Do you advise them to be aggressive because these are the times they can create additional alpha and equity? What is your stance on the thought process during such market corrections?
Akhila has it is absolutely right. You have to stick to your asset allocation. In fact, we have also done some rebalancing in our clients' portfolios, where depending on the risk profiles and other things, what I have also advised is like, maybe this is the time, a beginning of the time to aggressively do an investment in the equity. I will tell you, these are the times where you will get once in a lifetime times. Like for example, COVID, it was once in a lifetime fall. You can't actually time the market, but you need to look from the 5 years perspective. You need to look which are the possible periods where you will get the lowest of the markets. If you have that conviction that yes, this is the market that has fallen. Maybe from here it might fall 5-10%, but that's okay. We are in the long term. We are in a process of building long term portfolios. In such cases, I have advocated to my clients that open the gates for the equity portfolio. Of course, yes, when we go to the equity portfolio, we invest only into the strong, fundamentally sound companies. And I would also give a small example why this market, turbulence is a very apt time. Let us understand the good part and the bad part of these tariff wars. Let's understand the good part. These American bond yields have nearly fallen more than 5% in the recent 9-month period, and which really signifies that when the bond yield reduces, the money will flow back to the emerging markets in some period of time. Because we all are expecting that inflation will be imported to US when the bond yield raises, then there would be a time where foreign institutional investors, there will be a gush of foreign institutional investors coming back to the emerging markets like India. We have got
I'm waiting for that day, sir.
value. The second is we also should not forget that we are at the cusp of that moment where the crude oil is around 64 and 65. You tell me, when was the crude oil 64 and 65 in recent months? It goes to 80. It stays there for some time, but 64, 65, it's very good time to be in the market. Similarly, when the dollar index is around 103, it's very, very good for the developing markets. And I'm sure even the US also will try to reduce the interest rate, and so is the RBI. Tomorrow I'm also expecting between 0.25 to 0.5 basis points the RBI is going to reduce the interest rates. So we will be getting into that reduced interest rate cycle when the growth starts kicking in. Of course, we will have a bit of a stagflation period, maybe 1 or 2 quarters, but it will come down and we will get into the growth trajectory. So to answer straight to your question, we are advising our clients to increase the bit of allocation to the equity portfolio. And at this juncture, if you allow me 2 more minutes, I also want to talk about the mindset of the Americans. With all due respect, do you think unlike Asians, Americans have that mindset to work like Asians? I don't think so. Whatever our Trumps have wants build America, all these years, they are only meant to do the strategy, leave the rest to the world.
Yeah.
And now, if you ask that American to do both the strategies and build yourself, work in a manufacturing hub, I don't think he's going to do it. So it requires a complete paradigm shift in the mindset, I think it is not going to happen. So this is a bit of a tantrum which Trump has made. We have got this window to me personally, we have got a window of maybe 3 months, maybe 6 months, within which we may have to go and invest all out in our equity. So, and as I said, as I keep on saying, to me, I look this equity investing as a business model between 5 to 7 years. Not 3 years, between 5 and 7 years. That is where these are the pockets of times where you have to invest and stay invested. Staying invested is also like investing to me.
True.
So that would be my strategy, and we have been advising all our clients that way.
Great. Interesting insight. So, Mrs. Akhila mentioned that she would love to stick to the asset allocation diligently. You are saying that having the broad asset allocation, it's good to have some tactical adjustments depending on the market conditions.
Right.
So, different perspective, very interesting. Ashwin, a lot of investors during such volatile times, they tend to kind of prefer to invest in certain stocks which have fallen the most. Do you think it's the right way of stock picking?
I am somebody who is, you know me on a personal level. I am somebody who is dead against such a strategy because historically, what we have known or what we have been taught, and there is of course I'm a guy who goes by statistics, is that the stocks or the sectors that fall the least in a falling market are the leaders of the next bull market. It's as simple as that. We have to accept that, and it holds good 8 out of 10 times. So just because a stock has fallen too much, or technically speaking, if it has come to oversold region, it doesn't mean that you go and buy, because you have multiple stock examples wherein a stock has stayed in oversold for decades together. So I would completely stay away from such a strategy. It's very tempting. The current market conditions are very tempting. Sometimes money becomes limited. You want to invest in anything and everything that you can get your eyes on. But as human beings, we are allowed to feel those emotions, get tempted. But if you just give yourself a day's break and re-strategize of what this market calls for, you will know that either even in the previous podcast I mentioned, this is a good time for you to review your portfolio. If there are certain stocks that are underperformers, you can definitely weed them out, rebalance your portfolio, look at the new possible winners coming into the market, because this is a time I would really be working hard on stock selection and reviewing the portfolio. When it's riding up, we tend to enjoy the benefits, but when the markets are down, instead of spending too much time on analyzing what's happening and why it is, what is causing this turbulence, what I am just looking at what is the opportunity there is around, and just top up your investments and make the right choices. I mean, historically, this is what market has taught us to do. This is what the market demands. But when it comes to the execution, most of us shy away from it. And if we get the execution right, and I think you are a better person to tell me what is the kind of compounded annual growth the market can give us, provided we are. And then one thing, Lakshmi, like Prabhanjan just said, we are not here to time the market. In fact, market never gives us the leeway to time the market. Even if we do, there's not a medal that we are going to win because of it. It might just be a fluke. So instead of trying to pick the absolute bottom and top, we just have to focus on getting the right set of funds or the stocks into our portfolio and ride them as long as you can, provided they're fundamentally and technically sound.
Great. I mean, one important aspect that you just mentioned is portfolio rebalancing. Coming to Akhila. So, I mean, portfolio rebalancing plays a very, very important role in anybody's financial plan. So, do you actually go ahead and rebalance the portfolio during such volatile times, or do you stick to your discipline of rebalancing it at a particular frequency? So, what is your take on it?
Okay, this is a bit tricky to decide, and as I said, as a finance planner, we have to take the decision based on the financial goals. If we do the review every year, so this is a time we do a special review. So we see like every client, what is their financial goal, where do they stand, and do we really need to rebalance or not? Okay, so let's say for a particular goal which is far away, some 10 years, our call might be different, and something which is 2 years away, our decision might be different. It solely depends on the client and of course their risk profiling, which we are so bothered about. Okay,
very important.
Yeah, the risk profile, and also the duration to their financial goal. That's what matters. And one surprising observation which I made is this. What I see is the entrepreneurs have very less risk appetite. They take more risk in their business, but their investments, they're not ready to take risk. Okay, the salaried are ready to take risks, higher risks in their investments. Okay, and also the entrepreneurs, they are ready to take risk at this time of volatility, but the salary don't no, or rather I would say totally avoid taking risk at this time, because the time of volatility means there could be some major impact on their job security or something. An entrepreneur might be confident to earn more, in some way or the other. Maybe this is where I'm seeing this mindset uh, these days, especially during these times of volatility, irrespective of their financial goals. That is how the behavior is.
Okay. Great. For me, the biggest takeaways from this discussion, was while sticking on to the portfolio rebalancing during reviews. You mentioned about special review, right? That's a very good takeaway. I think that could be a good takeaway for our listeners today. Ashwin, yeah, you had something to say.
I was just, I suddenly recollected that I happened to read one quote by Jesse Livermore yesterday. He was predominantly talking about intraday momentum trading, and it goes like this: the desire for constant action, irrespective of underlying conditions, is responsible for many losses in the Wall Street. So sometimes, just to echo what Prabhanjan said, not doing anything also. Is it adds a lot of value to your portfolio. So the every time there is something, yes, you get attracted to the portfolio, to the need to evaluate it based on the present market conditions, but the conclusion of it need not necessarily be that you have to take some action. Inaction also sometimes does a lot of good to the portfolio.
Yeah. Yes, Mr. Rao.
Yeah, sorry. Since there is a lot of meaning to what Akhila and Ashwin has told, and one bit of thing I also wanted to add, which I've been doing it to my own personal portfolio in the last decade or so. See, what I apply as strategy is, when it is required, when it calls for a portfolio rebalancing, I would do it this way. Like within the same asset classes, there's nothing wrong to do a portfolio rebalancing. For example, I have a stock which I'm making at loss, and I have another stock where there is a lot of value in it. I don't mind to book losses here, square this off, and then invest in that, because I don't need to time between when I'm investing in the same asset class. When I'm doing the same thing with equities as an asset class. So we need to think of a rebalancing if we want to move it between the asset classes. But within the same asset class, I think timing is absolutely not required. It's only if we are required to do it, just go ahead and then do it.
Okay, you mean to say that always evaluate the opportunity cost.
Yes, we should within the same asset class.
Okay. One important aspect which Mrs. Akhila mentioned was, especially during this time, the salaried class would be at the risk of losing their jobs. So, a lot of, so-called, advisors on social media, they've been calling out at recession over the next 3, 5, 7 years. And listening to them, a lot of investors are considering to go completely defensive. I know that I'm coming back to asset allocation, but still, do you think investors should still go ahead, and change their complete portfolio allocations based on recessionary outlook? Maybe a couple of lines from all the three of you. Maybe starting with.
Can I go first? Look, this is a good choice to make, provided you were doing it at when Nifty was 26,000 back in September of 2024. At this point in time, all you'll have to be doing is, going from defensive to moderately aggressive. It's the other way around. It's this way. This is the good way, and not the other way around. Is my personal thought, and that is what historically markets have. Market has an expectation from you. When we all go into the market with an expectation, but for us to make money, market has certain disciplinary expectations from you, and this is one of it. So I would be going moderately aggressive on the markets. Why moderately aggressive and not completely aggressive? I always like to believe that there is a surprise element. and I do not want to be caught, by surprise from the markets, wherein there is an opportunity, but see, we all come with limited cash flows, and you always need to have that 5 to 10% liquid cash in the account, in the form of debt or liquid Bs to encash on the opportunity that the market throws around once in a while. But to answer your question, I am in total disagreement with this strategy. If it was at Nifty 26,000, I would be happily willing to do that.
Before I allow others to take over, I just want to make a statement here. At Nifty at 26,000, all of them would be looking at 30,000 as the next target. So this would never happen. Over to you, Mrs. Akhila.
I didn't hear.
No, I said that a lot of people in media.
Yeah. Just hold on. Your voice was breaking. Just hold on. Okay. Can you hear me now?
Yes.
Yeah. See, from a financial planning perspective, because I'm a financial planner, I'll give you this perspective. Each client will have, or each person will have a different exposure to the impact of recession. Okay, so if you see the COVID, okay, we all expected a recession to happen, and if you observe, there were certain people who really made a lot of money, and there was people who really lost their livelihood. Okay, so it depends on what kind of risk they are facing, how the impact of recession could be on them. Okay, so if they are at a risk of losing their jobs at the start of the recession itself, then obviously our strategy will be different, be in the defensive way. But if they are sure that they are going to continue with their jobs, their jobs are quite secure for at least another 5 to 6 years, then obviously the strategy would be different. Right, so it depends a lot of mostly what I see is people who are in the support level of work, or rather operational work, they are at a higher risk, and people who are mostly on the technical side and they have specialized niche skills, they are at lesser risk. So all these discussions we do in the beginning. We know the profile of the client, we know their risk profile, so we do take a call on that, based on that. And sometimes it's not just about their jobs or anything, even their family conditions. Sometimes slight variation in husband loses their jobs, yes, they have to be they will be willing to come back to get into the defensive side, or the wife has to take a break. Their strategy, or rather their requirements or their financial planning itself takes a total restructuring. We have to restructure their financial plan when such major life events happen. So, and recession is actually a part of their planning. In fact, during COVID, most of my clients who were in the corporates, we had kept aside a fund just to be used in case they lose their jobs.
Right. Very interesting. So according to you, the entire this decision should be individualistic, based on their individual financial goals and financial plan. Mr. Rao, your take on this?
Yeah, to me, I would take this from a macro perspective, and I will tell you how. See, if we analyze the entire, what has happened in the last 20-25 years across the globe, entire world will not get into a recession at one stance. So now, if we delve into the things, what has happened, US is the one which is getting into the inflation, because they are importing the lot of inflation. And to me, I'm not saying that this would bring in a lot of inflation. Yes, in the short term, US might get into a technical recession, but However, to me, after 2 quarters, everything will fall in place. It is just adjusting the entire global ecosystem. So now we are in the phase of adjusting global ecosystem. Now, I will tell you one interesting thing. During the phase of these adjustments, many countries who have been charged, who have been overreacting to the tariffs, there would be opportunities elsewhere. For example, I'll give you some of the examples. How India could benefit from this. India has been aggressively pushing Make in India to reduce the import dependence and boost exports. Why should we not think that this is the right opportunity? We can increase our quality and then boost Make in India. And similarly, Government of India has been giving a lot of incentives on the PLI, production linked incentives, since with US firms looking to reduce dependence on China, India's PLI backed industries could benefit. Why could not that sector, which has been beaten up, will be the right time to get into this, and then we see the compounding. So there is, to me, recession is look, we need to look into different countries. See, and again, in countries, we need to dissect which sector is into recession. So every sector won't be in a recession. That's what I personally believe, and it has worked for me. So apart from these two, Make in India, PLI, there are some other semiconductors and electronic industries where the government has approved, if I'm not wrong, 76,000 crores for this, to replace China in the global chip supply chains. And to me, this is in next 3 to 4 years. This is where we need to find the right sector, invest right time, and then what will happen when we invest at the right time by taking a little more risk is the power of compounding will kick in, and the rate of interest when it increases, the entire wealth creation will have a significant impact. Similarly, another sector where I will always see a pocket where there cannot be any recession is the defense exports, which with US and China tensions rising, India's defense exports, which grew 10x in the last decade, I will see a lot of increase going forward. So I don't see any recession in this particular sector. So to answer your question, we need to look from a sector perspective, look from value within the sector perspective, and then decide whether we are hit by recession or not.
Great. In fact, you're saying that even if the stock has been royally beaten over the last couple of quarters, it may not necessarily mean that you should do away with it. You could still go ahead and buy, provided you see value. Contrary to what Ashwin said, and this is what makes this discussion very interesting. Excellent insights in this episode. Kind of just capsuling it, we briefly touched upon the tariff discussion. We definitely spoke about the impact of this on your personal financial goals, importance of having an asset allocation and portfolio rebalancing. And we all Mr. Akhila also mentioned about a special rebalancing scenario, which is a very good takeaway for us. And we did speak about how individual goals does matter, and they'll have to look at their goal-based investments. So with all this, do not forget to consult your financial planner before making any investments. And though you enjoyed this discussion, none of these constitute any investment advice. So if you've liked this episode, please go ahead, like, share, and subscribe to our channel. Thank you everyone for this wonderful insights. We'll be back to you with another interesting episode with these three lovely people. Yeah, thank you.
Thank you so much.